Let's get more now with Dr. Stephen Nash from FIG Securities standing by. Dr. Nash, well, welcome to you.
Hi.
In spite of what was a very downbeat assessment by Fed Chief Ben Bernanke, well, what's your takeout from that? Psychologically, what's being engineered, if not behind the scenes, then subtly in front of the cameras?
Look, I think what Bernanke is doing is summarising the situation. As we've been seeing for the last few weeks, we've been getting a lot of weaker readings on US growth. The oil price is not helping there. I think he's basically just trying to lay the groundwork for, at some stage, to bring in QE3. But the problem is, of course, there's been a lot of criticism of the Fed for QE2. So I think they'll wait, they'll see how the numbers evolve. But QE3, I think, remains an option, but they need to be called into action to execute this, I think, given the criticism last time of QE2.
Yeah, what would they be able to justify a third round, though, as enacting if there's been so much criticism thus far? What will be different this time round?
Oh, I suppose some more, just weaker manufacturing data, weaker employment data, continued signs that the banking system is not lending. And I think you could see that in terms of the US banking system, given bond swap spreads, particularly in the long end, that the US banking system is really, they're not lending, they're investing. So they're investing on a long part of the curve. And I think that's something that's got to change over time. It hasn't changed to date. Hopefully over the rest of this year it will.
Is it possible to ring fence that money, to have strings attached? So yes, banks take it, but only on the understanding, on the proviso that it is lent out. You can't invest it.
Well, yeah. Well, I think you can see the effects of no lending in terms of the housing. The housing market has continued to be a problem. I think there's got to be more attention paid to the housing market. More policies are going to be developed. I think the focus has got to go off this budget wrangling onto the real issues of fixing the property market, and that just hasn't happened as yet.
What about the real issue as well of fixing employment? Because Ben Bernanke was trumpeting something to the region of about 700,000 new jobs would come from QE2. That hasn't happened.
Well, again, I mean, the problems with employment are very severe. The participation rate, as the economy improves, that will increase, and that will make the reduction in the unemployment rate even more difficult. I think we're seeing some green shoots of growth, but it's really slow. I think they've got to get those policies focused on the property market and also encouraging employment, possibly through some sort of taxation measure.
This was all predicated, some of those green shoots, was it not, on the crude price, on gasoline pump prices going potentially away from that danger zone of $4, $4.50 a gallon. The higher the crude price, though, runs up, that's looking like a bit of a pipe dream.
Look, I think the commodity price is really a function of perceptions of growth. Those perceptions are moderating, so I could see as the markets reduce the outlook for growth, that price will fall in line with that outlook for growth. So I think we're broadly seeing that already, and I think it's a matter of time before those commodities moderate in price a little bit.
Let's talk about the 10-year note and its position, and alongside the equity markets as well. What do you make of this failure to I guess, go a divergent route? You'd expect, would you not, a rally in that space as equities come under pressure, but we haven't seen that coming to pass.
Well, I think there's probably two things happening here. One is that the market's already come a long way. It's rallied a good 50 basis points. A bit of consolidation is needed. Under 3%, it's a risky area for people to take on long-term debt. The other thing is the budget wrangling, and I think at this stage it's probably worth 20 basis points, 25 basis points. It's really holding up the rally in the bond market. So if they can eliminate that, they're going to get bond yields lower, and that will help, I think, stimulate some lending and borrowing as well.
All right, let's talk about lending and borrowing back here at home. Bank of Queensland, the ratings agencies not liking its position. This occurring just days ago, effectively, correct?
Yeah.
What is that telling you about the two-tier nature of the property market?
Look, I think Bank of Queensland it's an issue of concentration in terms of funding costs, concentration in terms of geographic lending. They've got a large Queensland exposure, as you'd expect. So that's tending to have a negative impact on their outlook going forward. I think in terms of the Queensland economy, you know, obviously been severely hit by the flood. So right now they've also got issues with the commercial property market up there. It comes after a recent issue by the bank of some subordinated debt, and I think investors may be a little bit disappointed about that.
Well, just on a final note, when we reflect on that Reserve Bank decision, you were with us as it was handed down on Tuesday. Some of those price pressures which the Reserve Bank has no control over. Is this, again, one reason to believe they will just take a back seat, wait and see how, for instance, that story at the petrol pump plays out for another couple of months?
Look, I think that this idea is initially being generated by some of the data out of the Westpac Consumer Sentiment and Index and the family finances aspect of that, where it's showing that family finances are at a recessionary level. And I think the explanation for that are these uncontrollables, the things like utility prices and petrol prices that are forcing people to, they're squeezing budgets. With the prospect of increased rates on top of that, people are becoming much more conservative and they're just not spending. And I think we'll see those effects continued going forward.
Dr. Nash, watching it with interest as always, each and every month. Thank you so much.
Thank you.
Stephen Nash there from